All right, Chapter 8, Question 1A about inventory. All right, for this question, we have a company, ZZZ, for the month of May 2019. They had no inventory at hand as of May 1st, and they used the perpetual inventory system. All sales are on account. So we've got a bunch of transactions, and we will look at their transactions under three different scenarios. The first scenario is using the weighted average cost of inventory. So in this situation, our opening balance, we said, was 0 items. So we have 0 value, 0 quantity. On May 5th, it says we purchased 200 units for $10 a unit. So for this part of the problem, we want to record 200, $10 each, for a total value of $2,000. Gives us a balance of 200 units, $10 each for $2,000. Remember, weighted cost. May 7th, we sold 100 units to SSS for $30 each. So in this situation, on May 7th, we want to record the fact that we sold 100 units for $10 each, leaving 100 left, no change in our unit costs, and our value is now $1,000 remaining in inventory. Next item says May 13th, we sold 50 units. May 13th, 50 units. Pulls in our unit cost from our inventory, be $10 each, leaving 50 units for $500 in total value as of May 13th. May 15th, we purchased 70 units from Triple B for $13 a unit. This is where it starts to get a little tricky. So May 15th, we'll buy 70 units at $13 for a total value of $910. We have to do this slightly different for weighted average cost. You would then take your opening quantity of 50, add the 70, for 120 units in total. Our total value would be the $500 in inventory beforehand, plus the $910 for $1,410. In order to get a unit cost, then you divide the total value divided by the total quantity. So our unit cost, or weighted cost of our inventory, is now $11.75 each. Moving forward to May 24th, we need to record a sale of 20 units. Our cost for those units now, under weighted average cost, is the $11.75 each. So we have 20 units at $11.75 for a total sales cost of $235. Our units drop from 120 to 100. Our total value drops from $14.10 down to $11.75. And our unit cost does not change because it's weighted average cost, where sales do not affect unit cost. Last item, it says we purchased 80 units for $15 a unit. Similar to the May 15th transaction, we have 80 units, $15 each, $1,200 in cost. Our balance then is 100 units plus the 80 to be 180. Our value is $11.75 plus $1,200 to equal $23.75. Our unit cost then is the $2,375 divided by the 180, otherwise known as $13.19. The last thing to do is to determine some of your totals. So as of May 31st, we have total purchases of 350 units. Total value of our purchases being $4,110. Total number of sales, 170. The cost of those sales, this is your cost of goods sold for this month, of $1,735. And our closing balance in our inventory is the 180 units for the $2,375. All right, the next part of this question says, I use the same transactions using first in, first out, otherwise known as FIFO evaluation. So in this situation, we still have the same opening balance as of May 1st with nothing. We have the purchases, 200 units for a total value of 2,200 units, unit cost of $10. May 7th, we sold 100 units, no change, still the first items coming in, 100 units, $10. Next, May 13th, no change. Now this is where it starts to change. May 15th, we bought 70 items for $13 each. So now our inventory has two sets of items. We have 50 items remaining at the original cost of $10 each, and we now have 70 items at $13 each. This is important for FIFO. As we sell items later on, we'll sell these first 50 before we sell these 70. So the next transaction then, on May 24th, is we sold 20 units. We still had more than 20 units left at $10, so we will sell all 20 at the $10 rate, leaving 30 units left at the $10 rate and 70 at the $13 rate. Last item says on May 28th, we purchased 80 items at $15. So our closing inventory will consist of 30 items at $10, 70 items at $13, and 80 items at $15. So the difference in this situation is we still purchased 350 items. The total purchases were still 4,110. However, under FIFO and our costs continue to rise, our actual cost of goods sold dropped. Instead of $1,735, it's now $1,700 even. And therefore our value of inventory is slightly higher, 2,410, but still 180 units. The next part of this will actually use specific identification. So under specific identification, we're told to assume that the May 7th transactions and May 13th were the purchase from May 5th, and the sold on May 24th were from the May 15th purchase. So you'll notice a lot of similarities to the earlier parts. However, May 7th and 13th, our costs would come from our original purchase on May 5th, and our items from May 24th, being the 20 items, were from May 15th, so our cost here was $13. For our sales cost of $13 each. But similarly, your inventory needs to be tracked by the different cost groups by your specific ID. So at the end of the day, our balances will be 50 items left of the $10 units. We started with 200, sold 100, sold at 50. We will have 50 items at the $13. We had the 70 we purchased, less the 20 that we sold. And we'll have all 80 of our $15 items left because we did not sell any out of that group. Very important to pay attention to what specific items. Good examples is you could say these first items were pencils, these were pens, and this was paper. And the idea is you sold pencils here, you sold pens here, and you sold no paper. So just another way to look at it. Lastly, on May 31st, you will still have purchases, the same total, same quantity as before. But our cost of goods sold varies again because it's based on the actual cost of the specific identified items that we sold, totaling $1,760. And therefore our inventory cost is slightly less, being $2,350, but the same 180 units. The next component of this problem asks us to create the journal entries to record the May 24th sale. The May 24th sale, if you recall, were 20 units. Okay, and we have to record it under the 3 different scenarios. So under weighted average, being the first of our 3 scenarios, we had an accounts receivable sales revenue of $700 because we were told we sold 20 units for $35 each. Under first in, first out, no change because the sales piece. And specific identification, no change because the sales price was not impacted by the type of inventory valuation we have. Under the cost of goods sold associated is where you start to see the differences. If you look at our original chart, our cost of goods sold under weighted average was $235. Our cost of goods sold for that transaction under FIFO was $200. And our cost of goods sold under specific identification was $260. I will display it once we finish the discussion. The last piece is to determine the gross profit under each of the scenarios. So using this information presented, with sales revenue of $700 in all 3 cases, our cost of goods sold vary. So therefore our gross profit is $465 for weighted average, $500 for FIFO, and $440 for specific ID. The last part we're asked is to explain which one has the highest profit. So in this situation, yes, FIFO has the highest gross profit. Generally speaking, when the cost of goods continues to rise, the cost of goods sold will be lower when using FIFO because the oldest or the lower cost items will be debited to the cost of goods sold account first. Therefore, your gross profit will be higher. Obviously, the inverse is true. If your cost of your inventory continues to decline, your gross profit would be lower under FIFO, opposite of what we're saying here. In a moment, what I'll do is provide a snapshot at the end of the video of all of these tables together. Above And on screen, you have a summary of all of the different methodologies, as well as the journal entry on one page. So you can compare the various data. Hope this was helpful.